That's a write-off. I think most people have seen the meme or seen the video from Schitt's Creek, and honestly, it's not that far from the truth. Most business owners I talk to are really confused about what is able to be written off. Before we really dive into that, I need to walk you through two things. One is the difference between a tax credit and a tax deduction, and the other one, what can actually be written off versus what can't be if you take the standard deduction. Let's start with tax credits versus tax deductions. Tax credits are a dollar for dollar reduction in your tax bill. If you owe $10,000 in taxes and you have a $5,000 tax credit, you now only owe $5,000 in taxes. In reality, there are very few tax credits out there. Tax deductions reduce your taxable income. So if you make $100,000, you have a $10,000 deduction, your taxable income is now $90,000. What this means is that it saves you $10,000 times your marginal tax rate. So if you're in the 22% tax bracket, you have a $10,000 deduction, you save $2,200 on taxes, not $10,000 like many think. So tax deduction reduces your taxable income, saves you by your marginal tax rate. Tax credit is a dollar for dollar reduction in your tax bill. Some tax credits are refundable, which means if you owe $5,000 and you had a $10,000 tax credit, you can get the $5,000 back. A lot of them are also non-refundable, which means, hey, if you owe $5,000, you have a $10,000 tax credit, you don't get anything back, but your tax bill moves down to zero. The next thing that people need to understand is the standard deduction. In 2024, if you're married, you have a standard deduction of $29,200. So if you make $100,000, you don't have enough itemized deductions that beat the standard deduction, then your taxable income gets reduced by the $29,200. So you would save $29,200 times your marginal tax rate on this year's taxes. Many people talk about things like state and local taxes, mortgage interest, charitable contributions as things that reduce your tax bill. And that's true, they can, but that doesn't mean they do. They only benefit you if the total of all of those are past the standard deduction. So let's say your state and local taxes are $5,000. You donate $10,000 and your mortgage interest is $5,000. The total there is $20,000. You'll compare that to the standard deduction and say, oh, that's $9,200 less. I'm going to take the standard deduction. But many people talk about these things like it saves them on taxes. And again, it only does if it beats the standard deduction. And even if it does, it might only benefit you a little bit. People will talk about, hey, I bought this home and the interest is a write-off, so it's not a bad thing. And they'll end up at $30,000 of deductions versus the $29,200 standard deduction. You only benefited by $800. This isn't some huge reason to buy a house. Now that you understand the difference between itemizing and taking the standard, I want to walk you through 8 things that most business owners think are deductible that aren't. The first one is entertainment expenses. So many times business owners talk to me about this and they're like, oh, I'm going to rent a boat and that's going to be deductible, or I'm going to buy tickets to a game. And at the end of the day, that is not a deductible expense. The food there might be, but the entertainment itself is not deductible. The second one is country club memberships. Believe me, I wish country club memberships were deductible. I love golf just as much as anybody else, but that's just not how it works. You're not going to go sign up for a $100,000 down payment and a $1,000 a month country club and get to write it off because it counts for business purposes. That does not work. The next one is commuting to work. So all the time people will say, oh, I'm going to buy a business vehicle. And you ask them where they drive to and they say, well, to and from work. Well, to and from work actually doesn't count. If you're driving travel for work, different mileage like that, you can write off the mileage. But when you go to your office or from your office back home, those are not deductible. The next one is clothing. So I've talked to many people who are like, oh, but I buy this suit because it's for work. Or, hey, I buy this for this. At the end of the day, you're not going to be able to buy something from Prada and get to write it off because you have to look a certain part for work. The only time you might be able to write it off is if it's a uniform. So everybody at McDonald's has the same uniform. That is going to be different than, hey, I need a nice suit jacket or I need a nice pair of shoes to look good for my clients. The next one is inventories. So most business owners are like, oh my gosh, it's December. We have a bunch of profit. We don't want to pay a lot of taxes. We're going to buy $100,000 of inventory. But how inventory shows up is it shows up as an asset on your balance sheet. And it doesn't become an expense until somebody buys that. That is the most common method. if you are on the hybrid method or the accrual basis. The next one is volunteered time. So obviously a lot of business owners, your greatest asset is your time. It's very valuable. You might charge a high hourly rate. You can't go volunteer and then write off your hourly rate because you did that. You can only write off the gifts for the value that were given. And again, it has to be above their standard deduction with everything included for that to even benefit you. The next one is business travel. So caveat here, your business travel is deductible. So, hey, I need to go somewhere to see a client or meet up with somebody and I'm going to stay in a hotel, travel, blah, blah, blah. That is deductible. But when you say, hey, I'm going to go take, my wife to Hawaii. I'm going to work for 1 day, but I'm going to be there for 10. You are not going to be able to write off all of this on your taxes. That's just not really how it works. If you only spend 10% of your time on work, you're going to only be able to write off the part that you actually did for work. I see this as something people do all the time. They try to extend it. They try to write it off. That is a huge risk, and by IRS tax code, that is not deductible. And then the last one is donations to non-charities. So oftentimes people are like, oh, there's this local person, they needed help, I gave them money. And while that is really, really kind of you to do, and nobody's telling you not to do that, you just need to understand that it does not count for a charitable deduction. The only time it counts is when you give to a legitimate charitable organization. You need proof of the receipt, and that ends up being something that can be deductible. So at the end of the day, there are a lot of misconceptions on what is deductible versus what is not. Make sure you understand it so you can better plan around your taxes. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.